Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Fakhrullah Mijam SARIM, matric number 20BB04002. Today, we want to discuss about the equity market in chapter 6. Okay, the introduction. Definition of the equity market is a platform that allows businesses to raise funds from a variety of sources. As a result, a firm issues stocks which investors or traders buy in the hopes of profiting from future stock sales. The stock market and the equity market are sometimes used interchangeably, as they both serve the same objective of facilitating stock trading. However, in addition to exchange, stock markets include over-the-counter trading markets. There is two types of equity market: secondary market and primary market. For secondary market is where shares that have already been listed on one of the exchanges can be traded again. And then the primary market is where a company's initial public offering (IPO) takes place. To put it another way, this market is solely for the launch and investment of initial public offering. Okay, then the equity market growth in Malaysia. So the Malaysian Stock Exchange enjoys a diverse investor pool with strong support from domestic institutional investors, domestic retail investors, and just under 25% investors reflect foreign institutional investors. So the total market capitalization from the Malaysian Stock Exchange is at 1 Rm 1.711 billion as of December 2019, with Sharia compliant companies accounted for 77% of the total Malaysian market capitalization according to Bursa Malaysia. Ini saya dapat dekat capital market Malaysia. Tu kenapa dia dari 2019.
Assalamualaikum warahmatullahi wabarakatuh. My name is Hatim Fatim Madarail. My matric number is 19BB03006. Today I will talk about participant in equity market. There are four. First is company, second is retail investor and institutional investor, third is financial intermediaries, fourth is regulatory authority. For the first thing is a company. Many companies from various segment, region and size issue their share to the general public in the equity market. For primary goal of company is to raise fund, stock share issue. Company require fund for operation and expansion, and equity share assist them in this endeavor. On the other side, the investor who purchase their shares receive a portion of the company ownership. When buying equity share, the investor also get a vote for the company. Why company issue stock for various reason. To avoid debt. Using share is mostly done to avoid debt. stock exchange business is raising capital without incurring debt. Expansions of founding company frequently sell stock at operation time. This is due to the fact that stock sale can be used to fund expansion. To increase borrowing ability, using stock and assets avoid borrowing money and make future borrowing easier. This is because using stock reduce a company debt, resulting in improved overall finance stability. Public lease company. There are two types of public lease company. First, a Berhad, shop of Berhad, is a symbol denoting a publicity trade firm. Limited is the BM term for it. A Berhad at the end of the company name indicate that is a public limited company. The second is Sindiran Berhad. You will notice that a majority company use a Sindiran Berhad, which stand for Sindiran Berhad and donate that they are a private limited company with no public share. Blue chip company. Blue chip refer to the highest value of all the chip in a poker. Blue chip stock for the most part come from well-known corporation with well-known product and service. The general rule of thumb is to buy blue chip stock if at all possible, as they are said to be more stable. The reputation hold true in any market where stocks are said to be resilient to market pressure and economic downturn. For example, blue chip firm at United States is Microsoft, Tesla, and Coca-Cola, and so many. Apple. Regulation. The regulatory authorities serve as a market security service. Their primary responsibility and goal is to ensure that no fraud occur and the interests of investors are protected in all regulatory, controlling, and operational matters. The Security Commission Malaysia (SC). The Security Commission Malaysia (SC) was found on March 1, 1993 under the Security Commission Act of 1993 (SCA). They are self-supporting statutory entity tasked with regulating and developing Malaysia capital market. The Security Commission Malaysia (SC) is responsible for developing and enforcing capital market rules, ensuring a long-term market growth and development, supervising capital market activity and market institutions such as exchange, clearing house, and registered market operator, as well as regulating all entity and person licensed under the Capital Market and Service Act 2007. Security Commission Malaysia (SC) responsibility include using the capital market to promote innovation and digital service. Second, creating a venue for a sustainable financing ecosystem. Third, good corporate and governance is something in position about facilitating greater cross-border regulatory cooperation and thought leadership. Developing the total capital market as well as market divisions such as stock, bond, sukuk market, Islamic capital market, fund management, derivatives, and other market-based platform and service. I will give to the next presenter.
A financial intermediary such as commercial bank, investment bank, mutual fund, or pension fund acts as a mediator between two parties in a financial transaction. The equity market has a large number of financial intermediaries, which help it to run smoothly. Consumers benefit from financial intermediaries in a variety of ways, including safety, liquidity, and economies of scale in banking and asset management. Function of financial intermediaries. First is convert saving into investment. Second, stored by intermediaries such as commercial bank. Third is clients are given advice on how to invest and grow their money. And fourth is accept deposit from customers who have cash on hand. This is 4 types of financial intermediaries, which is banks, credit unions, insurance companies, and financial advisors. First, banks. These middlemen are permitted to accept deposit, make loans, and provide a variety of other financial services to the general public. They play a critical role in a country's economic stability, and as a result, they are subject to stringent regulation. Credit union. It is a form of bank that serves its members rather than the general public. They may or may not be in business for profit. Insurance companies. Insurance companies provide coverage to mitigate the risk of default. If you had a dangerous investment and wanted to reduce your risk, you would go to an insurance provider. And last is financial advisor. These intermediaries may or may not provide financial products, but they advise investors on how to attain their financial goal. Specialized training is frequently required for this financial advisor. Advantage of financial intermediaries. First is low risk. Lenders want to reduce the risk of capital and interest loss on any loans or financial investment they make. These risks may manifest themselves as a risk, default, or capital loss on stock market assets. However, the risks associated with secondary securities are significantly lower than those associated with primary securities for individual lenders. Second is greater liquidity. Financial intermediaries provide their lenders with much more liquidity on their secondary securities. The liquidity of bank demand deposit is excellent. They can be tapped into at any time without warning. Even time deposit can be withdrawn if certain requirements are met, such as a little interest loss. And third is convenience. Financial intermediaries help people save time and money. You save time and money by locating the best lenders. You delegate that responsibility to a specialist so that you can focus on more vital tasks. The deposit they sell are standardized, and data about them is easily accessible. Disadvantage of financial intermediaries. First, there could be a lot of fees and commission. Fees are charged by financial intermediaries for their service. This cost may be increased. Second, they charge borrowers high interest rates on loans. The majority of financial intermediaries charge borrowers a high interest rate on the loans they provide. Third is, it is possible that the returns on investment are low. Financial intermediaries may offer clients low returns on investment made on their behalf. This is due to the fact that their primary goal of profit take precedence over high interest rates for investors. Retail investor and institutional investor. Institutional investor is any company or individual that deals in big amounts of securities on behalf of other companies. And retail investor is a person who trades securities through brokerage companies or other intermediaries. Difference between retail investor and institutional investor. First is scope. Retail investors have limited access to certain markets such as forward markets and swaps, while institutional investors can invest in a wide range of securities and marketplace. Second is fees. Retail investors that trade infrequently pay greater cost per deal, while institutional investors pay lesser fees per trade. Third is frequency trades. Retail investors trade on a regular basis, while institutional investors trade often. Fourth is ownership of the invested capital. Retail investors put their own money into the market, while the capital of shareholder or organization is used by institutional investors. These are the types of retail investor and institutional investor. For retail investor, the type is stock traders, bond buyers, retirement account contributors. And for institutional investor is insurance companies, pension fund, mutual fund, and hedge fund.
Assalamualaikum. My name is Muhammad Daniel bin Uzaimi. My matrix number is 19BB03016. I will continue to present about the instruments of the equity market. Instruments of equity can be defined as documents that serve legally applicable evidence of the ownership to the companies that will exchange with the investors. It refers as part of a claim or right to a company's asset then issued to get source of funds. Instrument of equity generally issued to the shareholders companies to get source of funds. Secara umumnya, instrument of equity adalah untuk mendapatkan source of funds. Apabila investors membeli saham, dia adalah merupakan sebahagian daripada syarikat. Investors boleh membeli saham dalam mana-mana syarikat yang mengeluarkan ataupun menjual saham, dan mereka akan mendapat dividen daripada profit syarikat tersebut. Pembelian saham boleh dilakukan dalam public market atau private market. This is the types of the instrument in the equity market. Firstly is common shares. Common shares is also known as common stocks shares that represent ownership in a company. This share is issued by the public company to raise funds from the public. They will be a part of the ownership of the company and have the right to vote in the shareholders meeting. They also have the right to vote in choosing the directors for the company based on the majority of the shareholders. These shareholders will be paid the dividends out of the company profit. Tetapi dividen yang mereka terima adalah tidak tetap. Ini kerana mereka hanya akan mendapat dividen setelah ditolak oleh kreditors yang lain seperti bondholders and preferred shareholders. Contohnya, sebuah syarikat mendapat keuntungan dan dividen yang akan diterima oleh common shareholders ni adalah setelah ditolak bondholders and preferred shareholders, dan baki amount tersebut adalah dividen kepada common shareholders. Common shareholders facing a higher degree of risk than other creditors of the company, but they also have the potential of the higher returns. This is because these common shares can get many profits, but they also can lose or have no return at all. The second types of the instrument in the equity market is the preferred shares. Preferred shares also represent as an ownership to the company or corporation. These securities have a priority claim over common shares on the company's asset and earning. This is because it have a fixed dividend. Dividen yang diterima oleh preferred shareholders ni adalah tetap, dan pembayaran dividen kepada preferred shareholders ni adalah lebih utama berbanding kepada common shareholders. These preferred shareholders have the rights to claim the company's income and asset if it is liquidated, and these preferred shareholders also do not hold any voting rights. Maksudnya preferred shareholders ni dia tidak mempunyai hak untuk vote dalam meeting berbanding kepada common shareholders. And preferred shares can be classified into 4 categories, which is cumulative preferred stock, convertible preferred stock, exchange preferred stock, and perpetual preferred stock. The other type of the instrument in the equity market is quasi-equities. Quasi-equity is debt that appears in some aspects as an equity investment. Characteristics of quasi-equities would include either being unsecured loan or being a flexible loan repayment schedule. Mezzanine debt and junior debt are examples of quasi-equity, as they are both usually unsecured and flexible when it comes to the repayment schedule of the loan. Quasi-equity investments are usually based on the company's cash flow growth. These quasi-equities also is used when debt financing and share capital are not possible options of financing. Quasi-equities is dissimilar to a loan in the sense that quasi-equity financing is dependent upon how the company performs in the years to come. If the company fails to reach the expected performance benchmark, the investor receives a significantly lower return. However, if the company goes through a more profitable growth trend than expected, the investor receives greater financial return.
Assalamualaikum warahmatullahi wabarakatuh. My name is DARI PENJURIZA. My matrix number is 19-03014. Advantage of common stock. Okay, the first is probability of high return. Investing in common stock has a higher risk than more conservative choices such as saving account or fixed deposit account, but the returns are usually higher. Because your return as a shareholder are not guaranteed, there is no limit how much you can earn. And this is something that every investor wants and needs. Okay, the second advantage is easy buying and selling process. Okay, this type of investment is more liquid than the other securities. You may sell it whenever you want or purchase more if you want to expand your activities. Common stock also may be acquired at a reasonable price, as most of the financial advisor has moved to a zero fee approach for trades. Okay, and lastly is limited liabilities. If you buy common stock in a firm, your personal assets are not at risk if the company runs into a legal problem. The amount you put into the investment determines the degree of your liability. Only the company's executive would have to deal with the consequence. Disadvantage of common stock. The first is high risk investment. Investment will always carry some risk, but they are more frequent with common stock. Their prices are unpredictable and fluctuate widely. Even if the firm is doing well, the value of the stock might fluctuate without warning, making it impossible to measure their profitability. Next is lack of control. Company procedures and strategy has direct impact on your success. You will have to perform your analysis in other ways because you don't have the legal authority to demand a copy of their books or business plans. You are also a subject to the will of stockholder as a shareholder. You are unable to participate in the decision-making process or offer a better method of operation. As a result, if the stockholder fail to fulfill their duty, you may suffer the same fate. The disadvantage is last person to get paid. If the company goes into liquidation and you own common stock, you will be the last individual to get paid. You can only hope that you do get paid after every high rank does, including the creditors, employees, suppliers, and taxes. Advantage of preferred stock. Okay, the first advantage is first to receive dividends. When a company provides a dividend, investors who own this asset will get the first payout. This means that based on the percentage of shares you own, you receive the first right on whatever earning a firm makes. The majority of preferred stockholders enjoy a greater dividend rate than those who invest in common stock. Okay, next is it gives investor a higher claim on any company assets. The preferred shareholders has a higher claim on any corporate assets than someone who owns common stock if the company declares bankruptcy or liquidation. For the investor with a low risk tolerance, this benefit is extremely good. The firm will guarantee a dividend each year if this asset is held. If it fails to make a profit and is forced to close, you will be compensated for your investment. Okay. Lastly is easy to invest. Preferred stock are easy to invest in. Online brokers have made it possible to purchase stock with the touch of a button. Experienced brokers do not require a large initial investment to get started, and their fees and commissions are reasonable. Disadvantage of preferred stock. Okay, first is limited profitability. Preferred stock provide you with a set of fixed dividend payments that do not increase in conjunction with the stock's value. You will still receive the same fixed dividend if you invest in a preferred stock of a company that performs well and grows at an exponential rate. Okay, next is preferred stockholders don't get any voting rights. When it comes to corporate matters and choosing board members, preferred shareholders have no voting rights. As a result of their lack influence over this thing, they are unable to interfere when a firm makes a false decision. Okay, last is dividend payment not guaranteed every year. If a firm experiences financial difficulties, it has the option of not paying dividends to its shareholders. However, the shareholders will still receive the money in the upcoming quarter. Although this is a low risk investing choice, it should not be mistaken with a no risk scenario. You can still lose a lot of money if you take this approach. Advantage of quasi-equity. First, for core investors, there are higher returns compared to pure debt instrument. There are certain risk capacity limits in a specific market sector are addressed. Third is encourage local private equity firms to engage in riskier, where previously underserved areas. And fourth is it's possible that regulatory adjustment may be made to support the growth of the private equity sector. Disadvantage of quasi-equity. This type of investment is harder to manage than normal loan, more time consuming and cost more. Second is short-term financing is not an option because long-term returns are the only possible. And lastly, any additional service such as management expertise would be considered an expense by the corporation. Procedure in equity market. Okay, first is trading. The stock exchange offers an electronic trading platform with an automated screen. The platform is a free-to-use marketplace where buyers and sellers may view and place orders to fulfill their specific needs. Okay, next is risk management. A well-known stock market fundamental is that investing in the stock market entails a number of risks. A comprehensive risk management system has been established by the stock exchange to ensure the investors' interest and prevent fraudulent activities by the companies. The stock exchange upgrade its risk management system on a regular basis to avoid market breakdowns and stay up with the ever-changing mechanism. Some components of the risk management system include margin requirements, liquid assets management, and voluntary closeout facilities. Third is settlement and clearing. All trade transactions that occur throughout the trading day are cleared and settled by the exchange. These transactions follow strict settlement cycles with no deviation from the procedures. The stock market usually takes 2 to 3 days to process and settle the deal once it occurs.
The differences between debt and equity market. There are a few differences between debt market and equity market. In the debt market, it can be referred as an asset that require a fixed payment to be paid to the holders, including with the interest. The holders in debt market seperti orang yang memberi pinjaman kepada company. In the equity market, it is the owner of the company. Jika seseorang tu membeli saham dalam sebuah syarikat, ia adalah merupakan sebahagian daripada syarikat ataupun owner of the company. Next, in the debt market, it provides steady income to the investor. This is because they must pay the fixed payment with the interest. In the equity market, it get dividends only when company earns sufficient profits. In the debt market, the holders are lenders and it have no voting rights. But in the equity market, holders are owner and have voting right. In the debt market, it have low level of risk and it is borrowed capital of the company. In the equity market, it have high level of risk and it It is share capital of the company.
Assalamualaikum warahmatullahi wabarakatuh. My name is MEOR Asli Syafiq bin MEOR Muhammad Zahari. Number matric is 20BB04014. Okay, I will talk about instrument of Islamic equity market. Okay, the first thing is equity from Islamic perspective. Okay, the Islamic equity market is the same as the equity market, but it is Sharia compliant. As a Muslim, we are obligated to invest or finance based on the Islamic concept, which the assurance that the fund buy only Sharia compliant asset. At the same time, several non-Muslim are also interested in making investment and financing that are Sharia compliant. Okay, the following are the advantages when we invest in the Sharia equity market. Okay, the first is transparency. This is a guarantee that when investing in the Islamic equity market, where it has high honesty. After all, among the main objective of the market is to comply with Sharia law. Market management will be open about the industry and the company invested. Okay, the second is financial screening. Financial check are a step in the Islamic equity market to avoid investing in firm which to high level of debt. As is known, the screening process determines whether equity assets are Sharia compliant by making financial consideration of a company, including the amount of debt held by the company. Okay, the third is diversification. This diversity indicate that in Islamic equity market make investment in any market by purchasing asset from several company to reduce the risk of loss in capital loss when a company declare bankrupt or company closure. Okay, the last is liquidity. This liquidity is a process when the Islamic equity market focus on investing in fund from fixed term investment. This will result in a higher level of liquidity, which means that the investor will be able to withdraw money. Okay, for this part, component of Islamic equity market. In the Islamic equity market, there are several components that ensure every investment and financing is Sharia compliant. Okay, the first component is Islamic mutual fund or unit trust. Okay, Islamic mutual fund are managed in compliance with Sharia principle. Islamic mutual fund will unite with Sharia authority to monitor and ensure that each operation and portfolio is in its investment is managed in compliance with Sharia principle. Okay, the second component is Islamic Exchange Traded Fund, IETF. Okay, IETF is a benchmark index detector for Sharia compliance company. In addition, the management to IETF must be in accordance with Sharia principle and guidelines set for Islamic investment. IETF also conduct an operation by Sharia Board and committee to conduct Sharia compliance audit and review from time to time. Okay, the third component is Islamic Real Estate Investment Trust, IREIT. Okay, REIT is a real estate based investment scheme. It is an investment on a property by creating a profitable activity. This IREIT is made to ensure that the activity carried out at the property are from halal sources. Okay, the last component is Islamic Private Equity Fund. Islamic Private Equity Fund are a type of investment by making an agreement between parties. It has three types of agreement, namely Mudarabah, Musyarakah, and Wakalah. Mudarabah is an agreement made by two parties, which investor and entrepreneur. Further, this Musyarakah is an agreement in a partnership in which profit will be shared at an agreed ratio, and is the event of a loss, the loss will be shared according to capital contribution. And wakala is a contract between the principal and the agent to act on behalf of the principal until he die. Okay. Okay, for this part is type of security. Okay, the security market is a subset of the largest financial market in which security can be bought and sold between economic subject based on supply and demand. Okay, there are two main type of security in Islamic equity market, and that is equity security and debt security. Okay, the first is equity security. An equity security is a share of capital stock that represent a shareholder's ownership interest in a company, partnership, or trust. Share of capital stock include both common and preference stock. Okay. Holder of equity security are usually not entitled to regular payment, although dividends are frequently paid, but they can profit from capital gain when they sell the security. Okay, the second is uh, debt security. A debt security, also known as bond or sukuk, a type of debt instruments that must be paid back, which term that specify the loan amount, interest rate, and maturity or renewal date. Bond can only be made by the government and firm only. Okay, government and corporate bonds, certificate of deposit, and collateralized security are example of debt security that's entitled their holder to regular interest and principal repayment regardless of the issuer's performance, as well as any other contractual right which do not include voting right. Okay.
Assalamualaikum warahmatullahi wabarakatuh. My name is AHMAD AKMAL bin ANUAR. Nama matric 20 BB040010. Today I'm going to introduce about underlying Sharia contract of stock. Underlying Sharia contract of stock is based on musyarakah contract, and it is a joint enterprise or partnership structure in Islamic finance in which partners share in the profit and losses of the enterprise, benefiting from interest in lending. This is prohibited by Sharia law. Then musyarakah allow a project or company financial to get a percentage of the actual profit based on predetermined ratio. Okay, next I want to talk about regulation on musyarakah. Every time musyarakah contract is applied, the following should be taken into careful consideration, which is concerning agreement and work, then capital, then and profit and loss. Okay, about concerning agreement and work, it is permissible to enter into a partnership with a non-Muslim or conventional bank as long as the business is acceptable from the Sharia perspective. Second, it is permitted for Islamic bank to cooperate with conventional bank in a syndicate project financing, provided that it is monitored by Sharia supervision process from time to time. Third, it is permissible for our partners to amend or modify at any point of time the term of a partnership contract. Fourth, all the partners have the right to manage the company property, whether to sell, to rent, or take in custody of partnership receivables and other, as long as the deal is within the company's target and bring benefit, except deals which could lead to loss. The agreement by all partners should be soft. And finally, all partners should appoint among themselves one representative or two as chief executive officer or managing director of the company, while the others will act as a member of board of directors. Okay, then we about to talk about capital. each partner Firstly, each partner should determine the sum of capital contributed so that the profit sharing will be done accurately, avoiding any potential dispute and disagreement. Second, debt could not be made as capital for musyarakah contract. And thirdly, money deposit in Islamic banks are acceptable to be made as capital in musyarakah contract. It is prohibited for any partner to guarantee other partners' capital from any loss or from the business. And finally, profit and loss. It is obligatory to state specifically the profit sharing ratio and its calculation to all partners. Second is profit sharing ratio is allowed to be based on the mutual agreement by partners and need not necessarily follow the sum of capital. And finally, loss shall be based on each and every partner's capital proportion from the sum of our capital. Okay, next I want to talk about Sharia ruling on common stock and preference stock. Okay, firstly, common stock. Okay, common stock in general, it is permissible if the main business of the company is in compliance with Sharia rulings. Organization of Islamic Cooperation Faith Academy, or known as OIC, they describe it is permissible to purchase, hold or sell its shares even if the company was to undertake prohibited activities such as borrowing money or invest its money on the basis of interest. The company can still be investors provided they fulfill certain criteria. Okay, I want to, next is a preference stock. OIC Faith Academy said that it is not permissible for Muslim to use preference stock. Meanwhile, Sharia Advisory Council, or known as SAC, of Malaysian Securities Commission, they said that only non-cumulative preference shares are permissible. They are based on Tanazul concept, where the right to profit of the common stockholder is given willingly to preferred stockholders. Then convertible preference stock, no normal fatwa given, although most Sharia scholars are concerned about element of gharar. Okay, next is about impact of Islamic equity market on Malaysian real economy. The impact can be two condition. There is a long term and a short term. Long term is the Islamic equity market contributes to the Malaysian economy through capital formation and capital efficiency, serve as a channel for growth. However, for a short term, only the measured Islamic equity market for the Islamic equity market turnover contributes to the economy with only equity productivity as a channel for growth. These results demonstrate that the Islamic equity market successfully direct and finances constructive investment activity. It is also shows that in general, Islamic financing is more likely than conventional finance to lead to genuine sector growth due to the emphasis on equity-based finance rather than debt-based finance.
Alright, so for the conclusion, an equity market is a platform that allows businesses to raise funds from a variety of sources. There is participants in equity markets such as companies, retail investors and institutional investors, financial intermediaries, and regulatory authority. Therefore, this chapter has instruments of equity market, like types of instruments, advantages and disadvantages, procedure in equity market, and differences between debt and equity market. And then for the instrument of Islamic equity market, such as equity market in Islamic perspective, component of Islamic equity market, types of security, underlying Sharia contract of stock, Sharia ruling on common stock and preference stock, and last impact of Islamic equity market on Malaysian real economy. That's all from us. Thank you.